Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating the session tonight with Rob Roy. As always, we need to go over some important housekeeping details about the session, and then I'll introduce Rob. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there. Certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. All right, so for this session, we are live streaming to multiple platforms, as those of you who have been with us for a while are aware, and for anyone who may be just joining us for the first time, welcome. We have a process for asking questions throughout the session. Rob goes through his general Q&A, or he goes through his general presentation, goes through some case study considerations, and then with the time remaining, we'll take some questions from the multiple different platforms that we're live streaming to. So with the time remaining, we're going to take a combination, again, from all of those platforms. If we don't get to your question, just know it has nothing to do with the validity. We just only have so much time in this session. Also take that with encouragement to attend the insiders meeting, as we have a 45-minute Q&A portion for our subscribers only in that session. So obviously a much higher likelihood of getting your question addressed there if we don't get to it tonight. So at any point throughout the session, please feel encouraged to write your question in the Q&A window. That goes for everyone on the other platforms, and of course for our Zoom audience. For our Zoom audience, any support-related queries I can handle in that chat window. Just make note that by default, it goes to hosts and panelists. So if you would like to make a comment or question for others on the webinar, be sure to change the "to" at the bottom to everyone, and that way it's visible. Rob is only going to take questions from the Q&A window, so make sure to write your questions in that window and not the chat. The chat is strictly for interaction amongst all attendees on, and again, for any support-related queries that I'll be happy to assist with. So we had a follow-through day to the downside with no real news, and wonder what that means exactly for the markets going forward. So be interested to hear Rob's thoughts as always. Looking forward to interacting with you all. Thank you for joining us for the live session. And at this moment in time, I'll introduce who we're all here for. That's Rob Roy.
Hi, everybody. Thanks, Zach, and welcome to TradeFinder Live. And along with Zach, I'd like to welcome all of you joining us on the various social media platforms, and look forward to getting to as many questions as we can towards the end. The way this works, just to reiterate what Zach basically already told you, we'll talk about the markets, but not just the U.S. market. We'll go through and look at our international markets as well. We have a lot of international viewers. We have a lot of international subscribers. We'll review any of our trade alerts from Elliott Wave Options, ewotrader.com, and then we'll look at a review of past case study considerations that we've identified here during previous trade finders. We'll see if we can find one for tonight, and then with whatever time's left, that's when we'll get to the Q&A. So we'll just go ahead and jump right in at this point in time. And for those of you that are watching on YouTube, hopefully you visited our channel, Elliott Wave Options at YouTube. We post a lot of videos there, and so gives you a chance to catch up throughout the week. But taking a look at the market, we did finish to the downside today. As Zach said, follow through from the break of the 10-day moving average yesterday. Interesting that we've had these down days below average volume. You remember, normally it's been below average volume on the up days, above average volume on the down days. So what does it mean with the fact that we're moving lower but below average volume? I think that's interesting. As you know, we have disqualified this wave 4, so we're going to go ahead and take that Elliott wave pattern off. Are we coming down just to test this 50-day moving average? If I take the moving averages off, we have that zigzag that we've talked about, and we got awfully darn close to hitting the zigzag target. And I know a lot of people try to give a little bit of excuse to, well, that's awfully close to hitting the 100% extension. And it is. Perhaps that's as close as we get. Maybe we're going to start back to the downside on a new move. But I will say that over time, these fib levels normally actually get hit, and you could make a valid argument like, come on, Rob, it's that close. That could have been the end of the C wave extension, and it may very well be. especially with the fact that we closed below the 61.8% fib level today. That I found interesting. Not surprising to see it come down and test this area. You can see all of this support resistance right through this area that we're at, but just a slight close below that is interesting. So I still say there's a chance we come back and touch that actual level. Getting that close to it, as I said, maybe that's the end of it. Certainly you could forgive by being off less than a point on the zigzag extensions. We're doing our Zig-Zag Mastery class right now. We'll be doing session 3 tomorrow night. Look forward to that. If you're interested in it and you haven't joined, you can go to ewotrader.com and join into Zig-Zag Mastery. All the sessions are recorded, so even though you may have missed the previous 2, you can still get those on recording. We have a lot of zigzags that we looked at last week that we'll be updating this week. Some that we thought stay away from those, some that we liked. So we'll give an update and see how those work. But really love zigzag patterns. And again, even though we got really close to it but didn't actually touch it, still keeps me with the thought that there's a chance we still go back and hit that level. So there's not really much else to say regarding the S&P. So I'll just go ahead and move on to the other U.S. markets. Let's take a look at the diamonds. We can see that we've moved to the upside, actually took out the August high on the diamonds, but then we've moved back there as well. So you can see there was the August high. We haven't actually taken that out yet on the S&P, not even really close, but we have on the Dow. And so the commentary that I've been bringing to you over the past several weeks is the Dow the new leader? Should we follow the Dow? Are we going to go make that new high in the SPY? It seemed like yesterday when the ISM report came out, the market shook off the jobs report. A lot of people look at jobs and say, oh, it's looking backwards. It's a lagging indicator. The job market is last to, in this case, fall, because we're in an area of rising rates. And it seemed like they just gave the market a pass on Friday. And I'll just go back to the SPY chart and you can see. But then looking at yesterday and today, 2 down days. Yesterday we had a hotter than expected ISM report. And I don't know why people felt like maybe that was more important than the jobs report being too hot. Maybe they view that the ISM doesn't look as far back as the jobs report does, or maybe they just felt like that's a double whammy. So we had 2 back-to-back economic reports that were hotter than expected, and that moved the market lower. But pretty good down days there on the Dow, and a tiny bit oversold on the Dow, the diamonds at least, not significantly so, but a little bit. And so then let's take a look at the Qs. And boy, the Qs are going to be interesting to look at, aren't they? Because that's the pattern that we put the Elliott Wave back on, has not disqualified yet. And so the 61.8% wave 4 correction, that 61.8% fib level is holding on the Qs, and we broke below the 50-day moving average on the Qs. Perhaps the Qs are the market leader. It's interesting when you're getting, basically we have 3 different readings between the S&P, the Dow, and the Qs, and that normally doesn't happen. They can be off a little bit, they can vary a little bit, but they're normally not this far out of sync, but they really are. I mean, we still have an extremely well qualified 5-wave to the downside pattern on the Qs. We no longer do on the S&P, and we disqualified the Dow a long time ago. So it just, we're still in that area of what in the world is going on in the markets. And I don't really think the market knows how to react or where we go from here. What I thought I would do, because the financials got absolutely obliterated yesterday, not a good day today either. And let's do this. I'm going to switch a little bit here. Let's show the XLF, and then I want to show you the yield curve. Look at that on the XLF. Moving to the downside here. We've talked about this before. Rising rates, not necessarily on its own a great thing for financials. You would think rates moving up is a good thing for financials. It's the spread. The spread is what is good for financials when they can borrow at a lower rate than what they're lending at. That's when financials do well. So the fact that rates are moving up, they moved up yesterday, slightly down today. We'll look at those in a few minutes here as well. But pretty interesting that the XLF got really crushed yesterday and with some follow through to the downside today. So let's go ahead and bring that yield curve up. And holy cow. Do I have to say anything? Look at that. It's just really hard to imagine. People can argue it's different this time, but for the length of time that we've had an inverted yield curve, for the amount that the yield curve is inverted, for as long as it's been inverted, I just don't think you can discount that. I don't care what scenario you come up with. The bond market is too good of an indicator. We can't ignore it. And so if we go back and look at rates, say, well, we were up yesterday, back down today. We're hovering around that 50% wave 4 correction there on the 10-year. And we're right at that previous wave 5 target going back to June. It's an area where if we're going to move back to the upside on rates, it would be here. Now, think about this. Remember that the market is always looking 6 to 9 months ahead. I think the equities market has been looking 6 to 9 months ahead as getting into the area where the Fed will be done with raising rates and back to lowering rates because they're likely going to go too far. I think that's even more likely than I thought before, with the fact that we're still getting these high readings, even with all of the rate hikes that have been put into the market already. They haven't worked their way through the economy. And boy, could they go another 75? 50 is what's baked into the cake for the December meeting. But if they went 75 again, based on these numbers, yeah, I think there's your recipe for a significant move lower in the markets. 50 basis points. I don't know how the market reacts to that. That's kind of what they're pricing in. It doesn't necessarily mean we're going to rally on that. If they only went 25, well, I think we rally on that. But it's all over the map with where things go with rates. And then we look at the dollar, and up yesterday and today on the dollar with that, it's right at the 38.2% fib level. We broke it a little bit, but we've bounced back to the upside a little bit on the dollar. So this is getting more favorable to equities, having a little bit of a pullback in the dollar, kind of a significant pullback, I guess, from the September highs. But if we turn and go back to the upside, not good for equities moving forward. So there's so many mixed signals still in the markets. And now let's take a look at the IWM. And we had looked at, could we get above that 190 level? No, we tried it twice. And so here we are back at 180 again. So it seems like we've spent more time at 180 now than we have at the 170 to 190 area, which has been the trading range, going down to 170 up to 190. So we've tried it twice. But look at all this time we've spent at 180. I think you can make a case for we're just kind of pegging to 180 rather than looking at the full trading range of 170 to 190. We've still been bouncing between those levels, but looking at the 180 level is just, the market continues to go there. Bitcoin is trying. It's really trying to get above that 16,000 level and make another run at 20,000. You can see that we moved up a little bit, but then look, I mean, absolutely no movement at all since then. So there's a 16,000 level. And if we can hold that and try to inch higher, we should go up and test 20,000, but without any sort of significant move, you know, if the equities market does roll over and we start heading lower, it's hard to see Bitcoin moving up towards 20,000. I think Bitcoin needs an end of the year rally out of the equities market in order to run up and test that 20,000. It's just that, I mean, it's like, why even bother having the markets trade? There's nothing going on in Bitcoin. It's just as flat could be, but it is above the 16,000 level. So you look at that and say, you know, if you're long the cryptos or Bitcoin specifically, that's at least a positive there. Taking a look at some of our international markets that we like to look at. We have so many international viewers. Look what happened with the EWA. Yikes. Now we have relabeled that to, we hit the 61.8%. corrective level in the wave 4. That's relabeled to a wave 5 to the downside. Is everything getting ready to change? Has that much changed just in a couple of reports that we got on Friday and Monday that we're going to relabel all this stuff? It doesn't matter, in my opinion, on the EWA unless we break below that 23 level. If we break below 23, then we have to look at, but for now, the 61.8% wave 4 corrective level is holding, but I wanted to show you that relabeling there and the potential for wave 5 to the downside still holding true. You know how much I like the 61.8% fib level. It's the strongest of all, in my opinion, and you just can't ignore it. You have to pay attention to it when you see something holding there. Canada is moving back. Look at that. So heading back down, we were looking at a corrective move back to the previous wave 4. Not there anymore. Everything is changing. So this is when you look at this kind of stuff. Those of you that are newer viewers, newer to Elliott Wave, whatever, you hear the criticism that you hear on Elliott Wave is it changes. Well, I think that's the greatest thing about Elliott Wave. I say this all the time. The markets are dynamic. The markets are ever changing. The markets aren't static. And if you don't have an indicator that's willing to quickly move when the market makes different moves, you're probably going to be in a bunch of losses before you figure out where things are going. So when you have an indicator that's quick to relabel, quick to change, that gives you a much better opportunity to profit from when the market goes through changes. So Canada's now at the 50-day moving average. So you can say no harm, no foul yet at this point. If we hold the 50-day moving average, perhaps it was just a little bit of a corrective move back down. You could even make a case that, hey, it doesn't really matter on the EWC unless we break back below 33. I wouldn't argue with that either. 33 being an area of support resistance. And as long as we hold above that, you can still stay bullish on the EWC, but a couple of ugly days there, tapping the 50-day moving average on the low. Just amazing the way things are changing. Let's look at the INDA for India, and there's that. I hate to call it a kiss of death, but my mentor, if some of you have heard me talk about this before, used to talk about 3 times the charm. And that's when you have a test of a resistance or a support level on the 3rd try, that whatever happened was going to move for the next foreseeable future. So there was an attempt there at 44. We tried it again in September, and we came up here again in November, and we've clearly been turned away. So from what he would have said, we're probably coming down now into this area, likely to come test the lows at 41 due to the fact that we've been turned away from that. Nothing's 100%, but that was an expression that he taught me and that he used to go by a lot. So he would have been short the INDA, looking for a move back down towards 41. So let's take a look at Germany with the EWG. And so the German market hanging in there with a 72% wave 4 correction, but still in a qualified 5 wave to the downside pattern. Barely, but it's still qualified. And we went sideways for so long, looked like we were breaking to the upside there, looked like Germany was ready to run. And here we are right back down to 25 again. So how Germany handles 25 over the next couple of trading days, I think, is going to tell us a lot. If it breaks below that level, do we come down and fill these gaps? Do we come make a new wave 5 low? Are we not going to get an end of the year rally? So look at the differences in the charts from just where we were a week ago. And so that's why I'm saying the markets are so dynamic. If you don't have a dynamic indicator, you're probably getting left behind. I do want to show Hong Kong with the EWH. Look at that. So if you're looking for a place, there's a move back to the upside there. How long can this continue? You got China easing their zero COVID policy, but it's been in reaction to the fact that their citizens are rioting. And you riot in China, you're taking your life into your hands. to do that, but they've had enough. You can't keep people locked away forever. They go crazy. And that's kind of what's going on there. Now, we do have a zigzag here. So can we go higher on the EWH? It's awfully close to that 61.8% extension level. Once again, normally those levels get hit. Is it going to go and move higher? I don't know. There's resistance there at 21, so that could get turned back as well. So yeah, not nearly as bullish in the markets as you could have made a case for over the past couple of weeks. I know a lot of you like to ask about the EEM. That's been a topic lately on, can we look there for a place to hide? It was either at the TradeFinder last week or during our insiders meeting, somebody was talking about how the old expression that when the US catches a cold, the rest of the world gets the flu. So we're holding above 39 on the EEM. So as long as we can stay above there, you can look at that as a potential place to be bullish. But can it hold it if we do roll over and start heading lower? Can we stay above 39? I wouldn't think so, but we're there now. So all we can do is analyze the data that we have at any given moment. That's what technical analysis is. And then we look at, okay, what's happened in the past when we've had similar situations. That's how technical analysis works. Gives you a percentage of accuracy based on what's happened in the past, because that's a fact. The actual past has happened. So as long as we stay above 39, you can look here. It's just, can we stay there? That's going to be the question moving forward. So, wow, pretty interesting there. I'm going to go ahead and look at some that I think you're going to ask about in the Q&A. So I'm just going to cover those off to start with the metals. We were looking at going long for our alert subscribers on the SLV or the GLD, the metals, but they just got too vertical. And this is exactly why I don't like it when things get vertical. I wish, look what happened here. So we went vertical here, boom, back down. Vertical again, boom, back down. I would like this a lot better if off these lows we had just gone in a 45-degree angle. But we are sitting above the 10-day moving average, and we're going to have to see if we can bounce from that 10-day moving average. If we can, there's still some upside on the SLV. Let's see what the GLD looks like. We talked about moving up towards 168, and we did. We went there. Now, this is one chart that hasn't relabeled. So we were looking at moving up to the previous wave 4 at 168. It's exactly where we went. So again, for those of you newer to Elliott Wave, this is what's supposed to happen. When you have a wave 5 that doesn't go past 100%, when you correct after the wave 5, you go back to the previous 4. And that's what we did. And now we've backed off a bit, but we are still sitting above the 10-day moving average. How about oil? We've talked about this, and there's so much commentary going on with oil and OPEC and wanting to keep the price up, cutting production, the oil cap on buying Russian oil, all the stuff that you're hearing about in the financial news. And here we are right back down towards 65. And we're below the 10-day moving average. We have a strangle on oil for our alert subscribers. And you could have looked at that when we bounced off 65 and got back above 70 and said, hey, let's take the puts off. This is why you don't do that. This is why you let it make its full run. So here we are back near the lows again. And so if we break below that, I've made the argument of, you hear all the stuff about production cuts, etc. But if the economy does go into a significant recession, that means demand falls off. Supply and demand always matters. Price to volume action always matters. So if we're going to go into an area where we've got higher inflation, so the consumers' pocketbooks aren't looking real good, and higher prices of oil, are we going to drive as much? Is that going to affect our travel decisions over the holidays? Maybe. But I think that you have to pay attention to this move back to the downside in oil. We're a little oversold now. Pardon me, from the 10-day moving average. You can see on the lows there with where we are from the 10-day moving average. So maybe we hold here for at least a little while at 65, but surprising to some that we've broken back to the downside with all the rhetoric about supply cuts that exist out there in the marketplace. All right, so let's take a look at one of our, and this is kind of going to be a dual thing here. We did look at Yum last week, so this is where we were, and I wanted to show you this. We did actually send this out as an alert to our alert subscribers at ewotrader.com. As you know, here at TradeFinder, we look for case study considerations, and then you're on your own. What you do with them, what kind of trade do you put on, when do you get out, all those questions that are left to you. But for our alert service at ewotrader.com, we send you out alerts for entries, any adjustments, and exits. And then you can see here that we had a nice move to the upside. There was the entry. You know about it because we looked at it last week. We had the zigzag pattern to the upside, and then looking at the close. So why did we go ahead and take this off? Because we didn't hit that exact zigzag target yet. Well, here's why. I didn't like this vertical move today. So we tried to go vertical yesterday and we came back down. We went up vertically today and it held for the most part. We ended up a little bit lower than where we sent the alert out and closed the position out. But notice the separation from the close and the 10-day moving average. I know that China's opening back up, and that's why there's been a bid in some of the China stocks. But that's just a bit too vertical for me. We're not walking away from this. We're going to keep an eye on it. Perhaps we get another entry if we come back down towards that 10-day moving average. But when you see that kind of separation in an overbought condition and you can make over 26% in 4 days, we want to take that gain. And so that's what we did. And, you know, we can look back at this next week and say, you got out too soon. It continued to go. And if it does, it does. But, you know, this is what our alert screen looks like, by the way, at ewotrader.com. So you can see all the details, you know, the entry, what the position is, commentary, you get a chart. You see where the position is every day. That's a mark-to-market graph there that shows where it is. And you see all that information from open to close, plus the position where it stands each and every day. Very transparent on our alert service. So that's going to cover YUMC, and then, you know, there we are. So are you still in it? If you're following it, did you look at it last week? If you're still in it, I hope it goes higher for you tomorrow. If you still are, I could be wrong, could have bailed too soon. We'll see. But I just didn't like the vertical nature of the move. I didn't like the separation from the 10-day moving average. We had a nice gain. We made the decision to go ahead and take it. So you'll be able to tell me. That's one of the beauties of TradeFinder here, and looking at all these things is we're accountable, right? We look at these things together. You're here each and every week. You know, you can go back and look at our past TradeFinders at our webpage on YouTube that I was talking about at Elliott Wave Options, our YouTube page, and see all of these case study considerations that we've looked at over the past on TradeFinder. So going back, there's only a couple of positions that could be considered open. Oshkosh, and you know, this is just not in a good sector right now. You can see there was the 10-day moving average. We had that doji. We're a little bit overbought, and we're down here testing the 50-day moving average. So we're lower than where we were at the entry. So this position would be in a little bit of a loss if you were following along with it. Do you hang in there? I think at this point, you give it just a little bit longer. We did hold the 50-day moving average. We're a tiny bit oversold. Let's see if the market turns around and we can get back above 90. If not, if we break below the 50-day moving average, I think you close that one. You exit that one and walk away. It's not really in a pattern. This would be a new impulse to the downside, so hard to know where that would end. So we like to make adjustments and stay with positions when we have an idea of what the pattern looks like or where things are going to go. But when we don't have any idea of what's going on, that's when it's time to walk away. Again, I don't think I would do it just yet. Give it a chance, see if it can hold that 50-day moving average, see if we can turn it back to the upside, but that one's on high alert to close out. Now, different story here on Monster. That one was 2 weeks ago, and once again, we knew we were overbought. Okay, we knew that that was an overbought scenario. It did move back to the upside, but then we came back down, and so we tested that level there at 100. And we held there pretty well. This one's doing okay. And we talked about how, or at least I remember saying that I like the sector that this is in because it's viewed to be a defensive sector. There's just certain things that no matter how bad the economy gets or how bad the markets get, this is not a sin stock, but this is a defensive one. But the sin stocks are alcohol, tobacco, and gambling. That's where a lot of money goes when things start to get dicey in the markets and dicey in the economy, because the viewpoint is, right or wrong, that people are going to find a way to drink, smoke, and gamble. That's our vices, regardless of what's going on in the economy. Same thing when you're talking about beverage stocks. So it's held above 100. It tested it. We are below the 10-day moving average, but that one's doing okay. I think you stay with that one. And so we just looked at YUMC, which is what we looked at last week. And so that one, we closed it out. So you can follow along and say, that was a great move, or you dummy, you got out too soon. You'll be able to know, and you can make your own judgments. I gave you the reasons why I didn't like the vertical nature of the move and why we went ahead and corrected it and took it off. So you'll be able to judge for yourselves whether or not that was a smart move or not. You could argue that taking a gain is never a bad move, but we'll see. So we have three, believe it or not, even with 2 down days in the market, we have three impulse trades that still look to move to the upside. ZTO, which shows up, now that one's a difficult one. That shows up a lot for some reason. I don't really know why, but it shows up in Elliott Wave patterns a lot. But the options are sketchy. Sometimes they're okay, sometimes they're just not. So it's iffy on whether or not you can put that position on. But let's go ahead and look at these three. The first one catching my eye is Cigna. Here we go back with insurance stocks again. We were looking at that. We've had that a couple times. And so that's another area of looking at defensive-minded stocks. Well, geez, ZTO it looks pretty good, but we're going to have to take a look at the options and see where they are now. As I've said, sometimes they're okay, sometimes they're not. That's a pretty impressive move to the upside. It is technically in a qualified 5-wave to the downside pattern, which is concerning to me, especially with the fact that we're right in a massive point of resistance. So I would have a hard time going long this one when we're in a qualified 5-wave. We were at the last fib level, though, 78.6. You break that, that's when you're disqualified. But can it break it? There's tons of resistance here. Perhaps it turns and rolls over. So it's made a really nice impulse move, but it's in a wave 4, so it's a corrective move from that wave 3 down. I think you just watch that one and see what happens. So I don't think I could do anything there. I'm interested to see what CI looks like because, as I've said, we've had good success with this in the past. It's in an area, insurance, that's defensive minded when you're dealing with weakening economies, etc. And that looks pretty darn good to me. Let me look at DMI. So we're turning back to the upside. I prefer when you have a move like this and it comes back down, I prefer to see the ADX make it back to 20. It didn't do that, but it is curling up. And we're right at this area. The DMI is suggestive that we will break above this resistance area. So we're going to be hard pressed to beat that one, I think, as far as our case study for tonight. American Waterworks. So let's look at AWK, see what that looks like. I think it's interesting. We're not dealing with, high-end, high-beta tech stocks when we're looking at what patterns are in these upward moves. That is a really good-looking DMI, extremely supportive. Again, didn't break below 20. I would have preferred that, but there is separation between the two directional indicators, and we have a disqualified 5-wave pattern. So take that Elliott wave back off. But once again, running up against a ton of resistance. So both of these two, AWK and ZTO, next week, those could look really good. To me, you gotta see them break these resistance areas first. It's got to get above there. Can it get above there? I don't know. Let's let it tell us. Let's not guess. The DMI are suggestive of upward moves, but I just think we're so close to, if we break above that level at 160, we got plenty of room. We're going to go to 175, so we can take that move. But let's not jump the gun yet. Let's let it see what happens. So what I'm going to do is I'm going to move over to the watch list, I'm going to put both ZTO and AWK. If the market changes its tune and those are able to break resistance, those could be interesting to look at. But as far as our case study for tonight, that's going to be CI. I like the safety net, if you will, of having an insurance stock with concerns about where the economy is going to go, et cetera, knowing that there'll be market rotation, there'll be money rotation, looking for places to go hide, because money still has to come into the market through IRAs, 401ks, all that kind of stuff, the dollar cost averaging programs. The money has to be put to work. It's got to go somewhere, and it looks for places to hide when you have scenarios like this. So I think that looks pretty good, suggestive that we'll break that area. So we'll put that on. We did look at LAD. I had on my watch list from last week. So let's take a look at that and see what happened with that. So that was Lithia Motors. And we were looking here, and we had a potential zigzag in this wave 4 pattern. And now we have, we have a downward zigzag here. We've got all kinds of stuff going on right here at 220. So if we go back and look at where we were last week, so that would have been the 29th, and that's what we were looking at. So we had this potential upward zigzag. Well, now we have a downward zigzag, which maybe it's the newest pattern. And that's not even, that looks pretty interesting, doesn't it? Because if we come down and hit that 100% extension, we close this gap. So it makes a lot of sense that we come down to 210, but that's not that very far. Well, it's 16 points. So let's keep that one on the watch list. I actually kind of like that one to the downside now. Yeah, I'm gonna let's put that. Let's move that over to. Let's do a bonus. So we have one up and one down. So we'll do LAD down to 210. So we'll add that in. So we got CI breaking through previous wave 3 to the upside. We got LAD potentially moving to the downside on this zigzag pattern. So once again, Zach, a bit early, 5 minutes early. So few extra bonus questions tonight with TradeFinder.
All righty. Yeah, no, I'm sure no one's going to be upset with that. Thanks for that presentation there.
Yeah, when we don't have many open TradeFinder case study considerations, it tends to go pretty fast. There's not as much to look at. But that's a good thing, because that means all the rest of them have closed out.
Absolutely. Well, let's go ahead and get to it, and we'll get as many questions in as we can. So this one has been in chatter for the past few webinars. Question from Gary here on YouTube is, Rob, what's the next step for CAT? Good day today.
It was a good day today, as we have puts on CAT. So that was nice to see that one finally give up the ghost. I would like to see RS act just like this. RS, I just don't get that stock for anything, why it holds in, but finally Caterpillar, and this is another one that I didn't understand why it was holding in there, made no sense from a fundamental standpoint, and it finally looks like it gave up the ghost a bit today. So when you see that, you're like, okay, was there volume? Look at that. So the market had below average volume, but Caterpillar had above average volume. So that's encouraging for it to come back down. We've been waiting for it since back here in early November for this to start to head back to the downside with the potential of closing this gap. So I don't see anything stopping it from continuing. This is what we thought was going to happen a couple weeks ago, 3 weeks ago. Hadn't happened yet, but perhaps it's underway now. So yeah, good day today, and still looks like we want to come down and test that 200 level and fill that gap. That would be really nice for our alert subscribers.
Absolutely. Yeah, we have some requests to fill the gap, please, Cat, from Mike. So yeah, no,
absolutely. I'm with you. That's what we've been looking for. So maybe today was the start.
Absolutely. All right, next up, we have multiple requests for good old Tesla.
Gosh, I almost did that one ahead of time. I figured that was coming. So it's almost like, let me just go ahead and show it. I know people are going to ask. So the 23% wave 4 correction, it labels it because technically that's a level. But as I've said before, if you read Elliott's works, believe it or not, he would still consider this to be one big impulse move lower, which is pretty scary in the world for Tesla. So we're at D-Day. At 200, we talked about that. Could it get back above it? 200 was where it needed to hold. It didn't. It tested it there in the middle of November. It tested it right here on December 1st, and now we're down. It's got to hold 180. If it doesn't hold 180, I don't think this wave 3 low holds. I think we're going to come down to 150 or below, right around this wave 5 target if we don't hold at 180. So last bastion of support here for Tesla, needs to hold 180. If it doesn't, I think we see that wave 5 target, which I know, unless you're short, which I don't know many people that are short Tesla. Everybody loves the stock and wants it to go higher. But right now it's nervous time. It's nail biting time. Please hold 180 is what you need. And it's not oversold. Now, the most positive thing that I can come up with on Tesla, if you're looking for something to hang your hat on, is there is a bit of a doji there right on that support level at 180. So maybe we get another bounce. Maybe we get another shot at 200. But that's all I can come up with. The rest of it looks bad.
We will surely find out. Always a fun one to watch. So we covered the SPY in great depth in the beginning. We had a few requests from some subscribers that joined us a bit late. Specifically, we have a question here from Salvatore earlier in the session saying, please look at the SPY with the 200 SMA and weekly also. So if you just wanted to give a quick overview there.
Sure. Okay, so there's the 200-day moving average, and there was a lot of chatter. I understand why you asked this question, Salvatore. Please tell us the correct pronunciation of your name. I want to get it right. But you can see that we went up and hit the 200-day moving average. There's a pivot point right there. A lot of chatter about this on the financial networks today. The fact that we turned back from that, and then you look, and if you're a DeMark fan who looks at these, Tom DeMark, who likes to look at drawing trend lines from pivot points, you can see there's one right there, and then there's a primary one there. So he would look at that as a potential shallow, but still downtrend. So something interesting to look at. And we haven't looked at the weekly in a couple of weeks, so let's go ahead and look at that. And there we have the chart holding in there at the 61.8% wave 4 level. You can see that the trend line is still there. Take the volume off because there's still 3 days to go yet, so that volume will change. But look at that. So we had the wave 4 right at 61.8%, also at the 200-day moving average on the weekly chart. But turn back, it's going to take a heck of a rally towards the rest of this week to break that down trend line. That looks pretty clean to me. So, you could certainly make an argument that we may come down and test that level at 360 again. It was a strong level to bounce from, and we have bounced. 61.8% fib level with the 200-day moving average made a lot of sense. But we got to get up. If you're going to be bullish, if we're going to have a rally into the end of the year, we got to take this out. We got to take that high out. And right now, it just doesn't look like the market wants to do that. The futures are up a little bit, but that's not really so great because we've had 2 pretty significant down days, 7 points to the upside. I don't think it's going to make anybody feel better if you're long the market. So with that, we'll see how any sort of a rally. We're already at December 6th. If we were going to have a rally, wouldn't it have kind of started this week? I don't know. We're likely to get a drift up between Christmas and New Year's. That usually happens. That's the Santa Claus rally that you hear about. You've also heard me talk about never shoulder to dull market. That's the quietest week of the year between Christmas and New Year's. nobody is there. Traders aren't there. The market tends to drift up then. Maybe we get a little bit of a rally there, but if we were going to get a running head start, probably should have started last week. And Friday, I think, tried on the heels of that shaking off the jobs report, but then not so much on the follow through Monday and Tuesday. Pretty interesting here to see if we are going to come down and test that level again or not. But we got to get back up to that. When was this? August? This August high here on the weekly chart to look for a rally, or maybe we just rally up to it. But close right, or no, we haven't closed because we're still only on Tuesday, but we're right at the 10-day moving average now. You could see a case for some sort of a bounce attempt tomorrow. I don't know if it'll happen or not, but that's your case for it right there.
Very well, Robin. If you wouldn't mind just quickly bringing up the CCI and then a quick comment on volume, and that'll be a segue into the VIX.
Okay, CCI is neutral. It's in the middle. It's not telling us anything. We went from negative 100 to 100. That's what's supposed to happen. It didn't make it to 100. If it had, we'd be saying we're going back to zero, but we're almost at zero. The CCI is 100% neutral. The DMI is not telling us anything either. There's just not much direction in the market right now. Looking at volume, hard to look at volume on Tuesday on a weekly chart. We looked at it, earlier on the daily chart, but on the weekly chart, we got 3 days to go. So that's kind of hard to look there. But let's go ahead and take a look at the VIX. If you wanted to look there, we'll go ahead and go back to the daily chart here. And there's no volume there. We can see that coming down and testing this level at 20. We broke it ever so briefly on Friday, but closed back at 20 and a little bit to the upside, and a pretty decent move back higher today. We're not overbought. There's not that much separation from the 10-day moving average. Perhaps we go up and hit the 50-day moving average or make a wave 4 there. I don't know if I'm a believer in this 5-wave pattern here. Are we really going to see the VIX down at 15? I don't think so. I think it's more likely if we hold here, the best thing you could ask for out of an end of the year rally would maybe be down to 2018. I mean, I could be totally wrong, but I just don't see 15 occurring on the VIX here anytime soon, not with the uncertainty around, is the Fed now only going to go 50 basis points? I think you're going to start hearing some commentary of, could they go another 75? They don't want to, but with the data that we've seen, it seems like the market is concerned about that yesterday and today. I'll stop talking today so we get some more questions.
Yeah, no worries. So next up, we'll go to ENPH. This is from a Zoom subscriber saying new to Elliott Wave and would like to see the count.
Okay. And we have a lot of our alert subscribers like to look at the energy stocks on Thursday nights too. It's pretty interesting how many questions that we get in the energy sector. Ugly day today on ENPH, obviously. Tried to get above the 320 level, couldn't get the follow through, but I talk about this all the time, that when you get these vertical moves and you get overbought, when you're going to break this level, you can say, okay, well, you broke it. It was a significant break. But when it goes like that and it gets too far from the 10-day moving average and we get overbought, then there's no energy or momentum left. And so those moves don't tend to last. You want to just break and move in the 45-degree angle. So what happens? We fall right back down. It was too vertical and we got overbought. There's just not enough momentum left for it to hold. So now we come down and we try again. Hopefully, if you're long this stock, you give it another try and see if it can get back above the 320 level. A pretty ugly day today. Maybe it goes sideways a bit and then gives another run at breaking above 320. But that's not what you want. You don't want those big vertical days when you're breaking a major point of resistance or support on the other side because they just tend not to hold. And that's a perfect example of it. So can we hold here at 300? There's a lot of support here. So perhaps we gather ourselves and hang in here and take another run at it. We'll just have to wait and see. But if it breaks below 300, it's watch out below. Katie bar the door. And a lot of you like to hear me say, because that gap could get tested again. We filled it back here, but we could come down again towards that area around 260. But that's assuming that it breaks 300. It may not do that.
Very well. Thanks, Rob. We will move on to the next one here, and that is going to be biotech. And there's a good question around it. I should give you the context. Sorry, I was on a different tab doing a bit of multitasking. Is XBI forming an inverse head and shoulders reversal pattern?
Yikes, if so, but maybe.
XBI.
B, yep. I was just looking at the news headlines there because you get the Reuters headlines with the software as well. I don't know if you saw that or not, but it looks like Ukraine is firing rockets back at Russia now. It's amazing. They are fighting, that's for sure. So an inverse head and shoulders. I don't know. You know, this is. I look at this more as just plain old consolidation here around 80. There was a head and shoulders here, but it failed. You can see a little bit of a left shoulder there. We kind of call those, we talk about the, you know, humpback of Notre Dame there, because the right shoulder was higher than the left. So it wasn't a clean head and shoulders there, but it didn't break far enough down. So that was a failed one. We've got, look at every moving average here, 10, 30, 50, and 200-day moving average, all right there at 80. So perhaps you could argue that it's a good place to hide, but it's not necessarily going anywhere. Let's see where the ADX is on this. Not as low as you would think. The ADX is telling you that we could still go sideways some more. Maybe with what's going on in the equities market, sideways isn't so bad. I just can't really see much of where that could go. If the ADX had been down at like 8, which is what you would expect from a stock that's been in the trading range for as long as that has, and every moving average that we look at anyway, all at the exact same spot, you would think something's getting ready to happen, and maybe it is, but the ADX is telling you that it could go sideways just a bit longer. I don't know what to say about that one. I just don't have much of a directional feel on that one way or the other. 80 is key, but it hasn't gone much above it. It hasn't gone much below it. So even when it breaks 80, it doesn't do much.
Very well. Thanks, Rob. Next up, we are going to go with Meta.
Oh, we haven't looked at that one for a while. Good call. So let's look at old Facebook, now Meta. And yeah, I saw that this morning. It's like off to a bad start. And we had this wave 5 low here. We made it up to the 50-day moving average. It tried, no follow through. Talk about this all the time. This is why these rules are rules. You got to get a follow through day. So we broke above the 50-day moving average, no follow through day. So what happens? Here we are back down to the 10-day moving average again. Let's try again. We got awfully close to filling this gap, but we didn't quite. So that gap will get filled at some point. Maybe there's a Santa Claus rally at the end of the year, and that's enough to get that stock back up there. I felt like, you know, when we were down here, I believe I made the comment, you know, one of our alert subscribers is always asking for candidates for leaps. And I feel like, you know, if you want to just buy leaps and forget this one for a while, you know, you're putting a lot of faith in the fact that they know what they're doing with this metaverse thing. They're sure risking a lot, and they've sure wiped out a lot of equity and a lot of market value in doing this. Maybe they're right in the long run, and you know, jumping in now or and putting it away for a while turns out to be a smart move. But right now we're back to the 10-day moving average. It's had a decent move off of these lows, and I just would be shocked if by the end of the year we don't fill that gap. But if the market gets really weak, it'll have a hard time going there. But if the market just calms down at all from what we've seen in the selling, over the past 2 days. If that settles down, I think Meta goes and fills that gap, and then we have to see from there what happens. And I'm sure some of you are saying, yeah, but look at these gaps down here. Fair point. And that's what you have to worry about if the market does get weak and roll over. We're probably coming down to test those. So we might need to make a double bottom there. It's dicey. It's really dicey on Meta. The risk reward is not there to the upside. There's a little potential to close that gap to the upside, but I think there's more risk of it going lower than there is of it going to the upside. So I think it's a little bit more of a short right now, unless the general market finds itself and turns and heads back to the upside. But it needs to do it pretty soon, because yesterday and today were pretty ugly. I watched the intraday charts, as you know, and there's just no real significant buying attempts. Any little tick to the upside gets sold into immediately. So hard to imagine this going up unless the market changes. Something changes within the intraday dynamics of the market, which are pretty bearish right now.
Yeah, I totally agree with you. And it's just kind of hard to wrap the head around with heading into, the holidays, like you said, maybe a Santa Claus rally with how much of a VR push there's been in the past months and going to continue to progress. But
yeah, that's a valid point. VR is the one hot thing, right, for this holiday season. That's you're seeing a lot of advertisements for it. There's been a lot of chatter on it, but also the retail sector is not doing well. Not what you would expect to see going on. Let's just look at that real quick. Not what you would expect to see at this time of the year. You normally see this doing something like it did back in August, not rolling over. Well, we're coming out of Black Friday. If retail sector ain't going to do well now, when is it going to do well? So that's pretty scary, I think. Be quiet so we can get a couple more in real quick.
no worries. Martin would like to look at Microsoft.
Mr. Softy. And there was a lot of talk about Microsoft today with this. Right, that's my dyslexia there. MSFT.
I hear you.
But yeah, a lot of chatter about them buying Activision Blizzard, or did they buy them, or are they talking? I wasn't clear on whether or not the deal actually got done, or if they're talking about it. I think they're talking about it because they're concerned about some regulatory questions on it. So I don't know that it's a done deal yet. I think they're in talks. So, when you're looking at buying a company that size, it's not going to be a good day for you, because usually you take a hit to the bottom line, at least initially when you acquire something. But as long as it stays above 240, Microsoft is fine. If it breaks above 240 with that wave 4 right there at the 61.8% level, and if there's more chatter on that acquisition deal, you could look at a Microsoft down at 200 by the end of the year. I think you gotta touch, when you start getting these merger acquisition rumors, that's hands off. Let that play out. Because if it falls apart, Microsoft takes off. If it goes through, probably goes to the downside. That's just a really tough place to be right now, Microsoft, with all of that chatter going on with the Activision Blizzard potential buyout, merger, whatever you want to call it. Let's do one more.
One more. All right, we'll go with Lisa from YouTube. How about our poor SoFi? And Win rather, excuse me, said SoFi is at risk of actually exercising reverse split. So interested to hear your thoughts there.
Yeah. SoFi is pretty rough. We've looked at that one before, and I think when we were looking at it, said it needed to hold 5. It didn't. It didn't get back above 5. So whatever institutions may still own this, they gave it a shot back here, and they've given up the ghost, and they're just out. So it looked like they tried to support it here back in early November, and now they're letting it go. A reverse split is probably the only savior for that. And then I don't even know if that's gonna help. And reverse splits usually are extremely temporary. If you own the stock, it's horrible for you. I just don't know where the bullish case is. This looks like a good short to me, even with the reverse split. In fact, if they do a reverse split, I think is a better short at that point in time. So we'll see how that plays out. Did you say win or were you saying WHEN?
I was saying WIN. It's just the handle of one of our YouTube viewers.
Oh, okay. My bad. I'm going to go ahead and look at win anyway, because look at that. You want a bullish chart. What did I just get done saying? The sin stocks, alcohol, tobacco, and gambling. Win resorts. That's gambling. Look what's going on. Perfect example of what I was talking about. You want a place to hide? Look for the sin stocks. And it's actually overbought. Can you imagine in this environment a stock that's overbought, but Wynn Resorts is? So that's what happens. This is exactly what I was talking about. This is what goes on. It's overbought now. If he can get it back to 80, I think that's a great long. But it's got to get back there, and I don't know if it will. It's overbought right now. Perhaps it comes back a little bit. Maybe it just goes sideways and lets the 10-day moving average catch up. But if you wanted to make a note, if you could see Wynn Resorts back at 80, I think that's a great buy at that point in time. I don't know if it makes it back there or not. Thanks, everybody. Appreciate, as always, your time. We're super sincere about this. I'm really passionate about it, especially every day as I get older. Time's our most valuable asset. We very much appreciate you devoting some of your valuable time to us. And we really try hard to make it an educational and informative use of your time. Thanks, everybody. Have a great rest of your week.